Good evening, guys. So today is the third of a series of wealth management for working professional sessions. So we had already completed the last two sessions. So now we are going to recap what we have exactly last time discussed. Just a quick recap. So basically, wealth management is a matter of choice, and it is between the individuals how do they choose. So India's wealth pyramid, as we discussed, it is highly skewed. 93.3% of the population is having less than $10,000 income, whereas people with more than $100 million income is 760. And the next slide will make it a little more clearer. So about the definitions, ultra high net worth individuals are those people who have more than 10 crores of investable surplus. They are considered to be ultra high net worth individuals. And whereas high net worth individuals are basically who have investable surpluses between 1 to 10 crores. And these are the people, these two categories combined together, for whom there is something called as portfolio management services. And as per SEBI, it is 50 lakhs is what minimum required to have such kind of services. Since we are less, rather we fall under mass affluent between 25 lakhs to 1 crore, where we can afford to invest into it. So we fall into this category. This is the category that needs wealth management, and who will be the manager is ourselves. So this we have discussed about the process of diffusion of innovation, and also we discussed about Schumpeter's theory of innovation, where we try to understand why innovations keep changing, and with those changes in technology ideas, the way we handle businesses, that lead to a lot of creation of wealth. And the new kind of technologies come with a new order, which will replace the old order. Old order have either choices, either to join them or to beat them. If they can't, then they have only one option called as joining. If they can't join, then they will remain laggards, and they will be, we have seen, we discussed about many companies otherwise, like radio brands like Murphy, or TV brands like Onida, Western, all those, how they have totally got destroyed and demolished. And also we discussed how brands like Samsung, LG, and Sony, with innovations, they could sustain. Then it's the factors that determine is economic demand and supply. Rest are enabling factors. Whereas villain is basically inflation, hero is you. And we will be discussing a little bit about, already we have discussed about religiosity and wealth, and then millionaires and the case studies, and also strategies and mistakes by high net worth individuals. So going forward, regarding me, I'm a 2000 batch IRAs officer, currently posted as FINCO construction. I have a lot of qualification, which includes BSc, ICWA, company secretary, LLB, MA History, Psychology, Economics, MA Development Studies, MBA Finance, PG Diploma in Urban Development and Planning. Recently, I've completed a program from IIT Calcutta called as Chief Financial Officer's course. And then the post I held is mostly throughout my career, it was into railways. Initially NF Railway, then East Coast, then later I went to Railway Board on deputation as Director Finance. From there I went to Ministry of Finance as a Director Policy in Deepak. So currently I'm in SAG grade, working as a FNC Construction Southeast. So we have defined what the wealth is, and then religion and religiosity, and how religion and religiosity, and the relationship between religiosity and wealth is being discussed. And later we have discussed about the composition of, various caste in India, and who the rich are, and what do they represent. And then richness and religion we have discussed. It's a interesting case study. Then who owns the companies? In any case, the wealth of a nation is, or the rather wealth creators are those people who own businesses or companies. And since most of them, the private promoters who own 45.13 percentage of entire Indian companies. They are the ones who will be richest, obviously, and our slice will be much smaller in this entire pie, probably either in the mutual fund category or retail investor. So the countryside too is rich, and then we had a case study about Jewish billionaires, the chosen few by Marcelli Bozzini and S.V. Eckstein. Also, we discussed about what are the characteristics of rich people in India. Then the differences between the asset classes, which millionaire club, a global millionaire club holds and Indians hold. If you see, the major difference is they hold mostly asset or income generating assets like financial assets, and which gives them tremendous, access to wealth. Then when you see a typical Indian, the wealth held by Indians, can Anup, can it be please put under mute? Yeah, please put in mute. And then if you see the wealth held by Indians, mostly it is illiquid kind of a wealth, basically into property, either in the form of plot or in the form of buildings. So then comes is we are fond of having mostly illiquid kind of asset called as a gold. Gold, though both it is sentimental as well as we tend to think that gold is wealth, real wealth, and it is liquid only when we sell it. Otherwise, it is highly illiquid, and it don't give you any kind of a wealth unless you put into something called as a gold bond, something like that. And then 15 percentage of our wealth we put into something called as bank deposit, which give you a risk-free interest rate of somewhere around 7 to 7.2 percentage. Whereas we tend to have insurance 6.2 percentage. If you see the pie of the income or the so-called financial assets, you find equities as 4.8 percentage, whereas PF and pension funds as 5.7 percentage, which gives you a little decent returns compared to your bank. Then finally we hold it as cash. Cash per se, if you hold it in your pocket, it doesn't give you any return. So we had two case studies, A and B, regarding even the so-called successful people, and then how they take mistakes, they make mistakes, and they finally land up, losing a lot of wealth. And then what typical kind of a mistakes we do. Generally, normally, it's like we don't have a clear investment objective. Then what we tend to do is we tend to trade too often, whereby we tend to pay more higher commissions and fees, and also taxes. So we also don't have what is something called as a diversification. Without diversification, we are subject to a lot of risk, especially unsystemic risk, which is specific to the industry and specific to the company. Then we tend to chase short-term returns. In the process of chasing short-term returns, there is a beautiful quote by Peter Lynch, called as see, this strategy is called as cutting the flowers and watering the weeds. So then we time the market in such a way that we tend to put our money when the market is on a high, and then later, once it goes down or market is down, we tend to lose whatever we have invested, and then we lose interest in the stock market, and we tend to think that it is a gamble. And then we ignore something called as inflation and taxes, and then we tend to take serious too seriously the advices given by the friends, relatives, advisors, or stock analysts, or even the media, social media. So without doing any proper study, that is one of the major mistake. And then taking noises, especially by intermediaries like brokers, broker houses, analyst groups, media, social media, everybody too much seriously. We tend to because that is how they pitch. That's a marketing pitch, and you have to be very wary because it's your money. So if you want to have a proper kind of investment, naturally you have to do a careful study before you invest. Then we tend to emphasize on too risky stocks, especially the penny stocks and stocks which are underperforming. and sometimes you see that they are in upper circuit, maybe few days continuously. We tend to think that they may outperform the rest, but that is one of the major mistake where people like us, we tend to lose our money. Then we discussed about something which is often happening right now, which is called cyber attack, leading to loss of our wealth, and be wary of various kinds of frauds, especially electronic or otherwise. So what is the perils of a high network individual is like tend to put 85% of our wealth into physical and real estate, which is, as we discussed, it's prone to so many risks, and also you are sinking, it's a dead capital, and then it is very easy to purchase, rather it's highly difficult to sell off. And again, there are so many charges which are inbuilt, which you need to pay, and as an investment class, it's not a very high grade investment class. And then we have very less, only 5 percentage in terms of financial assets. This we need to shift to what global investors do have. So we have busted four myths about gold, and then real estate. Then the about real estate also, I have shown how, how many years you have to wait. In India, typically it's the best is Vadodara. It's around, it takes almost 25 years to make up your make a 25 years of rental income to make up for the investment you make. Whereas the worst is Vizag, it takes for 50 and a half years. So last time we have already discussed something about debt mutual fund, how they are as good or as bad as the so-called interest free risk. And the more debt fund funds which yield more interest rates are subject to default, risk of default, and which we have discussed in case study B. And then there is again one more myth we busted: GDP growth and stock markets. There is no correlation between GDP growth and the stock market. It's already proven. So don't be in that impression that GDP growth and stock market go hand in hand. And then obviously the only choice which is left out is the equity. Equity will generate you somewhere around 13 percentage returns, which is doable. It can go up to 20 percentage provided you choose very good stocks, which will multiply your wealth. That is called as power of compounding, which we will be covering in the later sessions. So Peter Lynch, who happened to be one of the famous fund manager, he said, you know what you own, and also you should know why you are owning it. So this is the philosophy. You have to have this as your philosophy if you want to have a exciting journey in your wealth management. Then the global shift, I think I have added two more graphs. I think this will be more clearer. So today it is 105 trillion, out of which around 25 percentage roughly is of USA, then followed by China, and India 3.71. So in 2050, Goldman Sachs, they have released one recently. It's a kind of a projection for global economy in 2050. What you find is Indian economy is bound to grow more than 5 times, whereas China double, US less than 50 percentage. So carrying forward, why I am saying I have put this is, yes, there is a huge scope for growth in India, and then naturally the entire growth story of India is definitely, it is based on how the corporates perform. So this will be the right time in case if anybody is interested. Equities is the segment where you can generate good amount of wealth. Then comes is the market drivers. We try to understood what the economic cycles are, from recession, slump, recovery and growth, how they are, and what are the factors that lead to that. And then we have seen that penetration of stock market and which states are having what numbers. Mostly, predominantly it is Gujarat 10 percentage, Maharashtra 20, Rajasthan 6, and then Karnataka 6, followed by UP, and then rest of the states. and then the penetration is hardly 4%, out of which 8 crore we have stock market users, and whereas mutual fund investors are only 3.5 out of 144 crore population, and in future to come this population is going to increase. That is the reason why naturally stocks also will grow. And globally, if you see, US with 48 percentage, where penetration when it comes to investing into stock markets, Australia 40 percentage, China 30, whereas India is 3%. 3%, I'm anticipating that it may grow up to maybe 10 percentage in another 10-20 years to come. So what India borrows, we had a kind of understanding about the segments, finances where money is pumped into. Majority or almost 50% towards to home loans, and then almost a quarter into personal loans. A rest followed by vehicles, and then rest of the things. So then now from today it will be like this will be the you know from here we will be starting. So as of now, if you see the entire stock markets over all throughout the world is somewhere around 108.6 trillion, out of which 42% share is by US markets, followed by Euro, then China, Japan, Hong Kong. In any case, India is also there, but that is shown in something called as rest of emerging markets, 9-10 trillion dollars. Out of this, roughly we are between 3 to 4 trillion dollars. So this is what is the strength, and it is bound to increase even further time to come. Then this is the interesting topic for today, like risk and returns. First, let us understand what is a return. So anybody would like to say what is a return? Definition of return? Anyone would like to say? How do you define return? Anu, Kripa, Ramesh? Anybody? Okay. If nobody like to say anything, I'll move ahead. Returns is nothing but the amount of appreciation you get for any investment you make. So usually when it comes to stock investments, it's usually something called as one is the appreciation in the market price. Second is the dividend. You have to add both to the initial investment. If you then only you will get something called as a return. Return is basically a percentage of the percentage above what you have invested. So if you tend to get the returns are positive, then it is positive percentages, or negative, it is negative percentages. Then there is another concept called as a risk, because everything, all these financial or any kind of investment, the basic fundamental concept is risk and return. If you don't understand these basic fundamentals, then it will be very difficult for you to go any further. So basically, risk is uh, uh, anybody would like to say, if you can go through, read it, and then whatever the concept you have, you can. Anyone? Am I audible to all? Okay, fine. So, could you say what is risk? And it's a very interesting thing. Anyone? Okay. So, risk is basically anything which is the definition given in the dictionary is possibility of loss or injury or something that suggests or creates some hazard, then the chance of loss or perils, and all these kind of a definitions. But actually risk is something which is negative or unfavorable or undesirable result. So That is what is called as a risk. Is a risk, uh, do you call it as a villain or a hero? How do you rate it? Is the risk a villain or a hero? Anybody? Newcomers? Absolutely, it depends. Actually, risk depends on how you handle them, right? Usually, there is a mantra called as TARA, TARA, right? Transfer. Either you transfer the risk, like purchasing a insurance, then reduce. R is for reduction. Then A is avoid, and finally A is to adjust if it is unsurmountable and you cannot avoid. So this is all about it, and it all depends. Depends on how you are. Uh, Actually, see, if you want to do well, you need to know what are the risks you carry. If you don't understand the nature of risk, if you don't quantify the risk, and then if you don't put this risk into your decision making, naturally you are going to make mistakes. So, and again, it all depends on your risk appetite. So, some people are willing to take risks, and there is a dictum or there is a saying that the more the risk, the more the returns. So lesser the risk, lesser the returns. So you have to take a kind of a judgment whether you want to go for high risk, high return, low risk, low return, or medium risk or medium return. So there are three strategies usually people follow. So next is like you need to understand what exactly the risk is. Risk is anything which is unpleasant, undesirable, or unwelcome, which you don't want. But it may lead to losses. If you if there is a risk, say if there is a you have a factory in X location, right? It is in a cyclone zone, and then there was a cyclone. So naturally, you lost like your whatever the investment you put in, that's totally gone, and then you have to again rebuild, refurbish, or again you have to put extra investment. So that will sink your whatever the profitability you will be having. Sometimes you may be totally out of business too, because the risk is so huge and the losses are so unsurmountable. It may be beyond your capacity to recoup. So this is about a risk, and there is always a danger, and we need to know. Then there are various types of risks, and then one is a speculative risk. You know that, say, suppose for best example is lottery, and then you know that lottery is a pure matter of chance, and you are taking a risk. What you lose, you may lose whatever you have put. If you gain, it may be, windfall gains. So you tend to, that is called as a speculative risk. And this kind of a behavior you find when people invest into penny stocks. They assume that if I lose, I may lose whatever I have put, but if I gain, it may be windfall. That is a kind of a speculative risk. Pure risk is basically you know that there is uncertainty, but you are not very sure what is it, right? And no possibility of gain is found in that particular risk. It's return is zero. So everything you will be losing it the moment you put something like casino. Once you go to casino, you assume that 99.9999% chance is that you will never get anything, so you'll end up losing money. So that is a pure risk. Then on the basis of flexibility, it can be static or dynamic. Static risk is irrespective of the change in the environment, the risk remains. Like natural calamity, dishonest employee dishonesty. Dynamic is it keeps changing with changing factors, like changes in inflation, consumer behavior, or consumer taste. The entire the dynamics will totally change, and the risk, it depends on the changes in these factors. Or you can say forex exchange rates also. This is also one of the area where you are exposed to so much of risk. Then there are two kind. On the basis of measurement, it can be either financial risk or non financial. Financial risk is where you can measure in terms of money. And non-financial is something like you cannot measure in terms of money, like suppose health. You had developed some disease or something where your health got deteriorated, so your potential to earn has got reduced. This is a non-financial kind of a risk. And then types of risks. On the basis of coverage, it is basically a fundamental risk, which this kind of a risk is there for the largest section of the society or the economy. Like in purely in terms of finances, it is called systemic risk. It affects everybody, everything. And then a particular risk which is called as unsystemic risk, which is associated generally with an industry or a firm or an investment option, right? And it will affect your rate of returns. Like these kind of risks are like industry specific or a company specific risk. Maybe the technology, their competitors are having better technology and these people are into obsolete technology, and they are competing with people with less skill compared to their competitors, or competitors engaging in some robots or robotics where the productivity has increased. And this company is into something called as a hazardous thing, where the risk is even further high and humans can't usually cope with it. And then there is on the basis of behavior, it can be subjective or objective. Subjective is based on the thought process. We may each individual have their own value systems and also thought process, whereby they perceive risk indifferently. Like each person, some people may tend to ignore that risk, some people may take it, they multiply the fear of that particular risk. So it's all subjective. And then objective risk is something which you can observe and you can measure it. So this will be an objective risk. And on the basis of diversification, either it is diversified risk, that is unsystemic systemic risk, which is firm and industry specific risk. If you diversify it, naturally as per the portfolio theory, your risk should become, the unsystematic risk should become zero. In case if you don't have a perfectly diversified portfolio, naturally you are subject to unsystemic risk. And non-diversified risks are basically systemic risks. Basically it affects the entire system, not just one firm or industry. So then there are other type of risks. Market risk. Market risk is usually caused by investors in reaction to tangible as well as intangible events. Suppose there is a unfavorable news which came in the market. So naturally people will behave in such a way that there will be a crash in the prices of that particular stock. So it will fall down, and then there is a herd mentality whereby people fear that it may further lose, so better to quit and then make money. So that is called as market risk. Then second risk is interest rate risks, and usually it is the central bank. In case of India, it is RBI. RBI decides on their interest rate generally into the entire banking sector. And if there is an increase in interest rates, naturally it will be viewed negatively by the market, and it will fall. And converse is also true. If there is a fall in interest rates, naturally markets will rise up. But again, we are talking about risk. Risk is always negative. So then debt price risk is also there. That is coupon rate of the debt security divided by market interest rate. And if there is a decline in that particular coupon rate, naturally then you'll suffer. So then comes is purchasing power and inflation risk. Inflation, naturally, it will make things more costlier. The more the inflation, and there is a risk that you won't have the surpluses to invest. And then when it comes to unsystemic risks, it is basically there is a kind of a business risk. And Company is exposed to various factors which are some of the factors are controllable, some are not at all controllable, or the so-called external factors. Due to it, if at all it leads to failure of a company, that is called as a business risk. And then financial risk is basically associated with financing of a particular firm. Is usually it is a debt risk. No, the more debt you take, the more you have the possibility of financial risk. It is called as leverage in financial terms. And then usually we have the market people say that the debt should not increase 30 percentage of your equity, something like that. Some people say 2:1 is better ratio, but these are all subjective, and it all depends on whether you are in a capacity to earn more than what you can pay. Otherwise, it's a pure risk. And usually a total risk is systemic risk and unsystemic risk. Systemic risk is something which affects the entire market as a whole, and unsystemic risk is the risk which is affecting a particular firm or an industry. So what are the types of returns? Returns usually are two types. Either it is a realized return or expected return, or which you anticipate. When it comes to stock markets, we say either real profit or the so-called notional profit or notional losses. So total return is basically income plus change in price movement, which we have already discussed. And return over is equity is your basically dividend divided by the price, or plus price changes in the price divided by the initial price. So how do you compute a return? It's basically there are various methods. It's like usually they take in the form of three. It can be either simple average method or geometric mean or the probability. And I would not like to spend a little more onto it because it will become more technical. And since I'm making it very general, it's just calculation of risk is returns is based on these three methods. And how do you measure risk? Risk is measured by in terms of standard deviation. Standard deviation with respect to the market index. Say if it is Sensex 50 or Nifty, sorry, Sensex 30 or Nifty 50 or any other Nifty bank or whatever the index which you put it as a benchmark. With that, you try to see your investment, and whatever the difference is there, that difference you basically square it. Later you put it as square root divided by number of observations. So this is how a standard deviation is obtained. In market parlance, it is called as a beta. Beta can be measured either through correlation or a regression method. Without entering into those methods and all the formula, I'm just giving you a kind of a brief. So there are usually used formula is a regression equation. Y is what the dependent variable. Alpha is basically the constant from where we start. I think next I'll be putting one graph with that. It will be more clearer. And beta is the slope, and x1 is the independent variable. So this graphs gives you the idea about risk and return in relation to various asset classes. So usually the lowest risk is said to be the risk-free bank deposit. So bank deposit is said to be one of the lowest, and below that is G-Secs, government securities, usually 10-year. The financial in financial parlance, 10-year government bond rates are taken as risk-free interest, and bank deposit give you a little better than those things. Then if you see the public sector bonds, then corporate bonds are a little more riskier, so they tend to give you a better yields. Mutual funds comes into the next category, and the most riskiest is the venture fund. And all those venture funding, all those venture capitalists, they have a huge amount of risk, and most often the venture funds go into into losses, and one or two will give them the returns which they expect, in fact much higher compared to. Somebody is raising hand. Venture fund, yeah, that's what I'm see. If you are a startup, okay, so how do you get funding? Basically you will start with your own money, or money from your own friends, family members, or somebody else. And many a times, whosoever your friend or within your circle, you will not have enough capacity to raise. So these venture funds are basically people who are high net worth individuals with a lot of deeper pockets, with a lot of understanding about idea, that particular industry and the business. So they are willing to fund a particular business if they find it to be very, which has a potential to give them the returns they are expecting. And then usually, as per market parlance, they fund. If they fund, say you as a promoter, you don't put any money into it. Usually 80 percentage of your profit is taken out by the venture capitalist, whereas the promoter or the originator of the idea, he will be left out with the 20%. This is usual. Like, it all depends on the negotiation between the venture capitalist and the individual promoter or the idea generator. Is that clear? Is that okay? Okay. So when we discussed yesterday, in the last session, we have compared the kind of assets which Indian high net worth individuals and the so-called global high net worth individuals. So you found most of their asset is towards the venture capital funds. They are into private equity, private debt, and all that stuff. So that is, they take a lot of risk. That is the reason why they get high returns. So again, as I said, risk and return is a matter of your behavior or your risk appetite, your thought process, and you have to be very clear what is your investment behavior. Accordingly, you have to adjust. So for that, you need to know whether you want to take high risk or low risk or medium risk. So I think there was an intense discussion amongst us, like, which gives more. Somebody in the recent past, they put something like gold. Gold will give you a jet, and then this is a study conducted for 32 years, from 1990 to January 2022. So in this, there are five asset classes. First one is Indian equity, second is US equity, third is India gold in terms of Indian rupees, and then the debt, then finally a cash. Cash is assumed to be, something like you are putting a fixed deposit, and debt means debt mutual fund. So if you place all these five together, you find that in that 32 years, cash has increased by 9 times, whereas the debt has increased by around 14 times the same period, and then gold has yielded 20 times returns, while US equities have given 55 times, and then Indian equity 68 times. And equity, in the sense, they're only indices like Sensex and Nifty 50, not any other. We didn't go into individual equity or any other index. Maybe something like in future slides you'll come to know how, I have compared around 17 or 16 or 17 asset classes, so you will come to know which gives you better wealth. So this is a very interesting chart. Like, this is how the in Sensex behaved from 1982 2023, the calendar returns, drawdowns are basically how low it went, and whatever you have seen is the returns finally you have got. So if you see, hardly most often it has means the positives are higher than the negatives. So average yield is somewhere around between 13 to 15 percentage. The CAGR, depending depending on where you have invested. So this is one interesting slide. If you look at, see, these are the risks which we have for the year 2024. This is a global risk, not individual. India specific risk is in the next slide. So for global, it is extreme weather event which have a very adverse. This one we can expect something like heat waves or cold waves. More than cold, it is the heat wave which will have a very destructive effect on especially agriculture, then even the productivity of the employees and all those stuff, and then the costs will keep on increasing. Then the second very interesting, I think you all have to be very wary about, that is called as AI generated misinformation. Don't assume that artificial intelligence is very smart. Artificial intelligence only fetches a lot of data. It has a capacity to compute. Computational capacity is much higher than us, and then it can go through number of thousands and millions of data points, and then finally they can come out with something, how a human writes. So if the data points themselves are wrong, or they are basically a misinformation, naturally they do generate a kind of a misinformation, and they don't have the intelligence to identify what is right and wrong. They just purely produce the information whatever is available within their database. So you have to be very careful. So these days there is a lot of marketing. If you see in Facebook, all that stuff, you say there is a quantum AI which is going to transform the way you invest into wealth. So if one information is wrong, if everybody commits a mistake taking a wrong stock, you also are doomed. So naturally you have to be very careful about this. Third is societal and political polarization, which we are seeing in India. In fact, indeed, this has been the trend throughout the world and more rampant in India. And this is one more risk. And the short term impact is likely to be very high. These three risks are very high impact risks. Then comes is the cost of living crisis, which is nothing but inflation. Inflation is another risk factor which affect all of us. So it has a moderate kind of a impact, so, short term impact, because RBI or central bank comes up with policies whereby they try to control inflation. So since it is controllable, it has a moderate risk, and all three, though the first one is not in our hands, so it naturally have a very high risk. Second one also, yeah, that is also not in your hands, whatever the data which AI has it. So based on that, and then whosoever are feeding that information, and unless they basically sanitize the data, otherwise it will lead to a lot of havoc. Then when it comes to polarization, in any case there is a risk, because parties, they want to survive and stay in power, so they resort to all these things. So this is bound to increase even in further time to come. Then cyber attacks, which I discussed in the initial starting slides. This is one more area where we are all vulnerable, and we are all, we at one stage or the other we will be victims of this, and be wary of it. Only thing is, you have to be aware of these things. The better you are aware, the better you are equipped to handle these kind of things. Then the third is economic downturn, which people are saying since 2022 I have been hearing that yes, globe is in recession, this, that and all. But anyway, it's like we don't know whether this is real or only perceived threat. But yes, it is also having a moderate kind of an effect. But again, since everything is a cycle and it can come up, so it is moderate impact will be there in the short term. Then a disrupted supply chain for critical goods and resources, like we have seen when it comes to during Ukraine and Russia war. We have seen the energy prices, especially the petroleum, gas, and the semiconductors, all these things, and certain minerals, where Russia happened to be a leading supplier. It was totally disrupted, but that was only a temporary, and then the likely impact will be a little lesser. Then the next risk which we are going to get impacted is escalation or outbreak of armed conflict. In any case, that is there. Right now, we are having this the so-called Russia and Ukraine thing. In fact, it is basically a NATO versus Russia. So that is one risk, and another which is ongoing is Israel versus Palestine. So these are the two ongoing, and we don't know in future to come what are those conflicts which are going to come. Yes, there are various flashpoints where yes there are certain risks, and that may lead to high impact on its impact on so short term is very high. And then attacks on critical and infrastructure, the likely impact is low. And then disrupted supply chain for food, we have lesser because we have wonderful distribution system and also storage combined together, and also the kind of a international cooperation and agreements the countries all over the world have. There is a very less impact on it, and whatever those will be a kind of a shortages, temporary shortages, rather than a kind of a long term. And then there is censorship and erosion of speech. It is it's likely to have a low short term impact because yeah. Okay. Hmm. Right, okay, I'll go to the next. So what is the biggest country where the threat of false information is highest is in India. So you have to be very wary of information which is shared generally either by the media, social media, or otherwise. You have to prune the entire information, identify how far that information is right, because that information will affect your decision making. And one wrong interpretation or taking a particular information too seriously may lead to a lot of havoc. So you be mindful and be careful. So now there are some interesting facts about stock markets, and then 50 percentage of today's Nifty 50 stocks will not be in the index in the next 10 years. So this is a very startling revelation. So accordingly, you understand, and don't put too much emphasis on today's Nifty stocks. They keep on changing, and 75 probability that there will not be in next 20 years. And then I'll show you those slide. The next slide will make it more clear. What are those things which are still existing and which in the last 30-40 years the companies which are in that particular Sensex, see I took it from Sensex, not from Nifty, but yeah, the same thing can be applied to both. In developing or emerging markets, there will be 25% to 40% churn every decade, meaning thereby in countries like India or even US, there the index, the companies in that index will keep on changing, shifting. One will fall from disgrace or being the darling of the market,
to some newcomers who will be entering into it. Some people may continue, some companies may continue. What are the reasons for such a? Number one is disruption of product and service due to evolving technology or changes in the consumer habits. Like in the past, we have already discussed, like radios. Once TVs have come, they are totally out from the market. Then TVs had a tough competition with computers. However, three companies could, you know, come up with new products, new technologies, like LG with QLED, then your OLED, then your Samsung QLED, and LED of Sony. So these companies could reinvent and bring a new product, and somehow they survive. Otherwise, all the old companies, they are all totally lost. And now there are the mobiles are, mobile phones and smartphones are now competing with TVs and also your laptop and your tablets or PCs. So this is how the disruption keeps on happening. And then second aspect is that disruption in supply chain and logistics. Suppose a particular, say, when it comes to heavily, companies which are heavily dependent on raw materials like minerals. If a mine is totally closed, then there will be a huge disruption leading to, like, in the recent past, might have seen the coal thing. The coking coal prices have shoot up by 10 times compared to what it used to be in the past. So it may also lead to, some companies, like, because of higher prices, some companies, especially like steel metal companies, they were totally lost because of these kind of, disruptions. Then a third major aspect is capital misallocation decisions. Like you tend to take mostly in this particular category, you find either there is something called as the so-called the related party transactions, where the holding company, which is owned by so many other shareholders or minority stakeholders, and between that and subsidiary which is mostly owned by the promoters. And if you see most of the companies which got collapsed, be it Satyam or the so-called Cox and Kings, all these companies, they're all because of a capital misallocation. Or else another area is like Amtech Auto, which has collapsed because of, the so-called very aggressive mergers and acquisitions without taking into account the factors, synergies, then how much, how how quickly they may get back their investment back. All these capital misallocation, and in the process of taking too much of debt, that may lead to problems. So we need to be wary about those companies whichever are trying to, do some such kind of capital misallocations. And this is one of the reason when they fall from, disgrace in the market, and then they are no more sought after by the market as such. And then there is a change in the management team. Then the management team, whosoever, they are not up to the mark compared to the previous the management, and they may take some decisions which may go against the company, and later it will affect their top line as well as bottom line. And then the fifth is related to complacency and lethargy. The best example is Nokia. Nokia at one stage, it was leading the entire market, and they were quite, sure and quite comfortable with the mobiles which they have made, and they failed to switch over to something called as a smartphone. Apple, along with LG, Samsung, these are the two companies which led the pack, and finally Nokia is now nowhere. So this also leads to, a similar kind of example is with when it comes to India, it is Hindustan Motors. When Maruti and other companies started coming, they failed to evolve. And, because of complacency and lethargy, they are totally lost. So now you see this. This is the composition of the Sensex over last 3 decades. If you see industry, it is divided into certain segments: industry, finance, then information technology, FMCG, energy, metal and mining, hospitality, and then engineering. Initially, this you find food and hospitality in 1998 having two companies, one Nestle and Indian Hotels. Later, they are not found in the entire the in Sensex in 2008. Next 10 years. Then in 2018 also they are not found. Similarly today. So if you see when it comes to engineering, L&T still is continuing. That is the only company which was existent since 1998 till today. Then if you see that industry also more or less from its initially it was having a major chunk to even today it's okay fine, and some companies still continue like Tata Steel is always there. Tata Steel and Motors are always part of this index. Then, if you see the finance is the area where the number of companies are increasing in the Sensex. So, similarly, if you see this energy stocks also have got dwindled from initially 6, 7 to now it's only 3. Whereas FMCG, if you see, is still the ITC and Hindustan Unilever are still continuing. They are still ruling the roost. Then when it comes to IT, yes, Infosys still is continuing and it has added few more companies. Whereas MTNL and NIIT, they were, and later Satyam, they were totally out from the Sensex. So if you, this is how the churn keeps on happening. So when you take any decision regarding any company, you have to understand this also. So the churn will be there, and you identify those companies which have a potential to continue for another 10, 20 years. Because decision, I suggest you, because being a working professional, it's always better to go for a long term approach rather than a short term. So, for those people who have not much of an idea, these are the top stock brokers in India. Zerodha is number one. Then comes is ICICI Securities, Motilal Oswal, Angel One, Kotak, HDFC, Grow, SBI Securities, IIFL, Axis, and so on. The list is there. Then a very interesting. This is one. Edelweiss has given some assessment in the early part of 2024 that the themes which you have to look into is the manufacturing, real estate, capital goods, and IT sector. And they were assuming that the earnings growth was 15 percentage in 2023 financial year, and it would increase to financial year 24 up to 20 percentage, and in the next this current year it was around 14 percentage. That means you can expect a dip in 6 percentage. So you have to be a bit careful. And then what they are talking about is while talking about 2024, it's about disinflation, bottoming global growth rate, and also elections. These are the three major factors to watch. Then again, now comes is the investment philosophies from the legends. In the next session, I think I'll cover something like maybe some discussion about Warren Buffett, because he is the most successful of all the investors who have continuously since last 20, 30 years. He has been in the top position, top 10 rich in the entire world. Somebody is raising hand. Yeah, Kripa bhai, Kripa, you have raised the hand. Anything? अच्छा उसको अन उसको ये कर लो. Otherwise, yeah. Okay. So it will be interesting. Like, see, very interestingly, Warren Buffett is the kind of investor who never uses computer all the so-called new technologies. At the same time, if you see his entire portfolio, he doesn't have anything called as a new gen technologies. Simply, he still continues the old ways. He has a fundamental core philosophy, and then which is quite interesting. I thought to put it, but somehow I missed to put those slides also. Anyway, next session I'll cover in detail. So what does it say is, Benjamin Franklin said, an investment in knowledge pays you best interest. You need to understand, nothing comes free of cost, and you need to have, if you want to be a good and successful investor, you have to spend a lot of time acquiring knowledge of the industry, then the players, then the factors influencing those industries, and economy, general economy, the behavior and psychology of the market players and also markets. So without that understanding, you cannot have any kind of a investment. So you have to be very careful about it. It's not a child's play. It is basically, if you don't have a proper knowledge and understanding, it is more like a gamble. You are speculating. Speculation is very dangerous. It is highly risky. Then Warren Buffett's core principle and philosophy is that you invest in those companies where you understand the business. Suppose you are into a technology, right? Say into electronics, and you have he says that if you want to be an expert in that, you need to have at least some 10 years of experience where you have fair amount of idea about what the entire industry is, who are the players, what are those various kind of technologies, how each are placed, what are the factors influencing that particular industry, then what are the forces, like Porter's five forces. That in future to come, I'll put all these industry analysis separately. So these all things, unless you have a fair amount of idea about this, and also what kind of it should also have a very favorable long term economics. Like that, you have to invest into those industries where the technology or the life cycle is so long that for next 10, 20, or 30 years still the company should be exist inexistent, and those companies or the products are still in usage. So for example, he has invested into Coca-Cola, then Union Pacific Railway, and then few railway companies. He knows that yes, irrespective whether we are existent or not, these kind of companies are going to continue. And he is very, very wary of technology, because technology keeps changing, and high technology have high risk. And a new product will come, then that substitute will attract more traction, and finally you lose whatever the business will be totally lost, as we have discussed in case of televisions and radios. And then third is, you need to have able and trustworthy management. And then Warren Buffett said that unless the quality of management is good, and if the stock that the prices fall, you better go into such kind of companies where the managers are too good, and they are trustworthy, and also they are honest and competent. Otherwise, you don't put into those companies where the promoters are very dubious, the directors don't have the skills to compete against their competitors, and all that stuff. Then the fourth one is a sensible price tag. And what he says is he's a champion of something called as a value investing. He says you have to take the great companies, take on those great companies which come with a attractive price. Or whenever there is a fall in price, say 30-40%, and then you know that this company is a very good company. The moment it falls, you have to purchase it. He goes contra to the market. See, we as an investor, investors have a herd mindset. They don't think. They think only after some time whether they did a right thing or not. So we tend to invest if there is a bull run. We tend to go and participate in the market because everybody is purchasing a particular stock. And when there is a crash, everybody wants to sell it off. Nobody has the patience. So what he says is everybody needs to have patience. It's all you need to understand. To be a very successful investor, you have to understand the business and the psychology of investors and investment in the markets rather than understanding the so-called finances of a company. And then a true great business is that has enduring moats and that protects excellent returns on invested capital. What do you mean by moat? Moat is nothing but a sustained competitive advantage. And if you see the Japanese companies, they have pursued something called as increasing the operational efficiencies. They went to such an extent that they have ensured that there is a very high amount of quality control, the so-called Six Sigmas, Kaizen, continuous innovations, inventions, and then they kept on reducing the prices. And in the process, many of these companies after 80s, Japanese companies totally lost the game, especially to the American businesses. For a simple reason that they thought that increasing efficiency is endless. It is not endless. It has a limit. कृपा भाई को थोड़ा म्यूट कर दो. So they are not endless, right? So to be very successful, for example, I'll quote one American company by name Nvidia. I think you all might have heard. I don't know how many of you know about it. Nvidia is a company which is having around 48 percentage so-called profit margin, whereas Microsoft has 36 percentage. So this is the margin that gives them the kill. They have internal huge surpluses. With that, they can expand. They can put more money into it, and whereby they get more profitability and they grow much bigger. So that is the reason why most of the large companies in the world are US based, be it Amazon or your what is that Amazon, Nvidia, your Walmart, then Apple, and all these companies. They are much bigger than many of the their market capitalization is bigger than many of the economies in the world, except for maybe probably Chinese. And even this Apple is almost near to our Indian GDP. So rest of the countries, you just imagine they are smaller than those corporations. So then what he said is he said another interesting thing. When we own portions of this is like the time horizon where you as an investor has to take. When it comes to outstanding businesses with outstanding management, our investment should be forever. The time of entry is immaterial. The businesses are excellent, outstanding, and the product will sustain for a very long term, and there is a continuous growth. You have to invest it forever. Examples are like FMCG. fast moving consumer goods or food and beverages, there are certain, these are called as defensive companies, where the demand will be stable irrespective whether you want to uh, you know irrespective of the kind of demand, you mean to say, I mean to say that, irrespective of the economic condition, these companies will have constant demand, and as long as the population keeps on growing, the demand for these products also will keep on increasing. Then second one is, when we hurry, this is a very interesting quote. Like, most often, this is the behavior of those people who fail in the market. That is like, when we sell great companies in a hurry to book profits and tenaciously hang on to the business that disappoint, is like cutting the lowers and watering the weeds. So, for example, like say we as investors, even I have adopted this business strategy, like investment strategy. What I used to do is, I used to think that yes, business is all this stock market is into cycles. It is sinusoidal, so there will be peaks. There will always be troughs. So every in a year there will be such three or four such kind of waves. So you can make money at least to 20%. I used to put 20 percentage as my minimum. What do you call profit which I am expecting within the short term. So I used to sell off those companies which were performing, which have just started the bull run, which went to 200, 300, or 400 percentage run. And then I was hanging on to those stocks which were, not doing well, and then they were going down, and then they are continuously into the southward direction, southward movement. And finally, it led to a huge amount of losses, and I had to book somewhere around 13 lakh losses because I was following that particular strategy. Then later I realized that it is not that. The companies which are doing great, they are the ones who are going to go up in the bull run. And even if there is a crash also, you need not, sell it. Rather, you wait. Yeah, the whatever the correction which the market takes is maximum 50% correction. So later it will bounce back, and that bounce back will be much higher than the crash generally in the market. So you need to understand this and follow a strategy which, Warren Buffett, and be wary of these kind of strategies. And then there is one more very interesting quote which you all have to follow it. Be fearful when the market is greedy, and be greedy when the market is fearful. During bull run, be very careful, right? That is the time when most of the people make losses. And then in during bull run, every stock tend to perform, and there are certain stocks which are operator driven in the pursuit of our greediness, and then to get rich quick. What we tend to do is, we tend to invest into those stocks which don't give you returns. These are all temporary kind of a thing, and they are operator driven. When they are going up, they are into always into upper circles, right? So upper circuit, and during upper circuit you cannot invest into it because the prices are too pricey. The moment you put an order, there will be so many buyers, there will not be any much of sellers. And then even after market orders also you put in, even then also you don't. The moment you get it, that is the time which has reached the peak, and the fall starts, and you will continuously lose money. So, and especially during during the market crash, what we tend to do is, the moment price keeps falling. Recently it happened with Paytm. I invested when it is at the top, so it started collapsing. Initially I put some more money, and then I waited till I didn't sell it, because I know that one fine day it will also come up. Otherwise, the model business and all that stuff is very robust. So I continued with it, and there are many such kind of stocks. Recently, IAFL was there, like it fell down somewhere around 40%. Again, I invested into it, and you always have that kind of a contrarian strategies. So the biggest success of Warren Buffett since 1953 till date, he is the only person who have beat the market consistently, continuously. So what he does is he always go for a contrarian strategy, going contra to the market. When the market is on the bull run, he will not buy anything. Rather, he may book. Rather, actually, he generally don't sell any of his stock. He will keep holding it. He will wait for an opportunity. Usually, what he does is around 30 to 40% of his money he put it into the short term, the cash, the so-called, you can say that debt funds, which are temporary, which have a temporary cycles, maybe 10, 15, 20, or 21, or below 365 days cycle. He keep on rotating the money, get some money as an interest, and he will wait for an opportunity. The moment he find a very interesting company which he feel that is a very interesting company, he will naturally immediately purchase huge amount of stakes in that particular company. And nowadays he stopped purchasing individual stakes, rather he is now purchasing the company as a whole. So these are the certain of the strategies which you need to understand and adopt, and this is the entire psychology of your market. Okay, it is of a particular individual stock. I'm not talking about uh, uh, you know the market as a whole. So during the stealth phase, they have given segmented the entire market, how it behaves, or the particular stock behavior into four phases. First phase is stealth phase. Nobody knows, nobody notices. Right? It goes very slowly. The people who are the promoters and certain smart investors, these are the people who know about that particular stock, and they know, and they keep on working on it, and they are least bothered about its market cycles. So there will be a stage initially, it will take off very 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 slowly, and then once it take off, it gains the attention of one media, or even the analyst. More than media, it is the initial attention is by certain of the analysts, some stock analysts, or some market gurus. All these people, they keep on tracking them. So they will generally identify, yes, this company is doing consistently very well for a fairly long enough time, and it is time to take off. At that time, they will invest. They, along with institutional investors, since they have a huge battery of so-called stock analysts, they invest heavily into it, and then institutional investors are the ones who initially start. Then comes is the first sell-off. If you see the first dip in this red line, that is basically a bear trap. So what usually people do is, some smart investors, usually individual investors or some institutional investors, the moment the price falls, they immediately sell it off, and then they leave. And after the crash, or the so-called correction, it will, because see, many a times these institutional investors, they have to give consistent returns. So what they do is, they keep on selling, and most of these institutional investors, especially FIIs, they're all basically either the pension funds, or some all these kind of a things, where they have to generate a regular incomes for many of the pensioners and all. In US, country like US, which is market driven, they generally have, they basically put their money into the stock markets rather than taking loans, or rather than depositing into the banks, because in those countries the bank interest rates are very low, 2 3 or 1%, so they don't get much money out of it. So what they do is they put it into institutional investors like mutual fund or pension fund or any of these kind of funds. And also, it is mandatory for mutual fund agencies to have a liquid cash, because nobody can control the redemptions, and to maintain certain cash, they have to book some profits. So what they do is they book the profit, and then that money will be distributed and some portion will be again reinvested. So later, during the awareness phase, once the thing, there was a bull trap, bear trap, then it will keep rising. Once price started rising, that is the stage where media catches attention. Once it catches attention, it keeps on, driving crazy. They keep on with coming with a lot of coverage, reports, and this is the area and stage where people like us, investors like us, keep, getting attention towards these stocks, and immediately we tend to put money into it. The moment media comes in, the the especially the buyers will keep multiplying like anything, and that lead to a lot of enthusiasm, later greed, and then into delusion. And as if, if you don't invest, you will miss the entire buzz, and that buzz will never come in next 10, 20, 30 years to come. So these kind of pitching up will be done by, one is by media, another is by the analysts, then even stock broking houses, all those stuff. And then people tend to become so mad. Finally, they put all the money and they go into a new paradigm when the stock goes to the all-time highs, and then comes the so-called crash. Once it crashes, many people who wanted to invest into it, they find it as an opportunity. What they do is, while it is crashing, we will tend to pour more money into it. And then those investors who thought about purchasing, now they enter into it. There is a phase called as a bull trap, where it gives a feeling that the stock is going to perform better, and it keeps rising a little, because nobody has seen what is the future. So naturally we tend to put money into it, and finally there will be a big crash. It keeps on going down. The moment the crash comes, people out of fear, they keeps selling it, and that will lead to capitulation, finally into despair, and it goes to so rock bottom that it will be totally gone, vanished, and finally it will go back to the mean, return to the mean. And this is how, this is a stage of bubbles, and this continues. Different stock have different cycles. Some stocks may outperform, they may have multiple stages of bubble and busts, and some companies may have only one, and after that it is totally bust. So be careful. This is what is the behavior of the market. You need to understand how the markets behave very wildly. And then there are various philosophies adopted by traders and investors. Some people say the market timers, they always time to they always time the market, especially entry and exit. And there are two kind of strategies. One is the so-called momentum strategy. The other is fundamental analysis strategy. Momentum is nothing but they go by the charts, the past behavior of, price movements, price and volume movements. They track, and there are so many indicators which gives you some idea when it's going to go up, what will be the support line, what is the resistance at which, the stock will not move. And there are so many patterns So they follow something called as technical analysis, and then these market timers, they try to time it when it is trying to rise up, and many a times they sell when it is at the peak. And since nobody can predict any future, that success of technical analysts is around 80 percentage, and then 20 percentage, when they lose very badly. So this is one strategy. Usually they follow something called as either intraday or short term. And as per SEBI report, 90 percentage of the so-called derivatives trading, they are all end up into losses, and the rest 11 percentage, it's not that they are making booking profits. If you add all the costs, like in terms of margin money, all that stuff, they also end up, majority end up into losses. And this the short term, when it comes to short term trading, other than derivatives, the normal usual stock trading, 95 percentage of people, they lose money. Only 5 percentage they consistently make money. So you need to understand the pitfalls. When it comes to long term, there is a very high chance that yes, you'll accumulate and multiply your wealth. Then second is, there are another two strategies, which some people called it as value investing. The other is growth investing. So in case of value investing, they try to find out a stock which is good, and then which has fallen by say 30-40 percentage. And in that there is one very excellent book written by Graham, who's that? Benjamin Graham, Ben Graham, okay, who happened to be the guru of Warren Buffett. He wrote something called as Smart Investor. He came up with a very interesting idea called as value investing. Value investing is nothing but it is a strategy in which fundamentally a good company is purchased at a very attractive price. Like when it falls down, then you tend to purchase it. So this is one. This is called as value investing. The other is the growth. growth growth investing. The growth stocks are those stocks usually into the high technology, where they are in the growth phase, or as we have discussed in the past, the cycle of any industry, it starts with the birth, then there is a growth stage, then there is maturity, then decline and death. So those emerging industries or technologies, these are the technologies initially they will be loss making, and then there will be a lot of growth potential, and then they keep growing. And what once the takeoff stage comes up, that is the time when people invest, and it grows so rapidly that many of the technology companies, they have grown 40, 50, 60 percentage or even more. Recently Nvidia, in last 2 3 years, it has grown around 200 to 300 percentage. So these are kind of a growth stock irrespective of PE values. Usually, some people adopt, like, we will purchase when the PE value is low, and then we will quit when it is on a higher side. So this, I think, we all keep listening in the news channels, newspapers, otherwise in discussions. So basically, this and also it was busted as a concept by a lot of research, especially if you read Saurav Mukherjee's Diamonds in the Dust. These concepts are busted, and there is nothing called as timing if you are going for a very good companies. And timing matters when you are a short-term trader, or you are into something called as derivatives market, options and futures. They are highly risky, and you have to be very, very careful. Then there are technical analysts, as I have told you, and then fundamental analysts, they usually do this value investing. Then value drivers across the cycles and sectors are totally different. And then what drives a particular company? This is a very interesting slide which will give you a lot of insights, like what you have to look at different kind of companies in different life cycles. If you find a young growth companies like technology stocks, what what drives the value is revenue growth. The percentage growth over last year or last 2 or 3 or 4 or 5 years, that is what drives. If there is a consistent growth, you have to see the revenue growth, how much it is growing, and the target margin, how much margin they are going to make. Usually young growth companies, you find that their margins initially starts with a negative to it will turn out to be positive. And recently I invested into Zerodha because it started booking profits. Till it booked profit, I didn't, because many a times all these companies, whichever they the so-called unicorns, majority go bust, except for very one or two which tend to become a huge corporation at the later stage. Like during tech bust, you hardly find Google continuing its struggle. I think you might have also heard that Google was consistently was into negative margins, whereas now Google has around 24 percentage margin. You just imagine, because there is a concept called as mm, platforms and the so-called pipeline. Pipeline is an old business where it is pretty straight in terms of initially input or raw materials are brought to the process at the manufacturing plant, then they generate a finished product, and finally those things are pumped in the to the market as a finished product. So this is the usual traditional approach. And then later came the technology companies, where there is something called as a in case of process the pipeline businesses, there is something called as a law of diminishing returns. Law of diminishing returns sets in because you cannot, one is that raw material or the materials are finite, and they get exhausted at one stage. Like mine can be closed, and oil well can be later, you can say it is abandoned, or all the, and the productivity of any particular product like coffee or tea can get reduced. You cannot infinitely increase it. There is a something called as a law of diminishing returns that creeps in. Whereas the new generation technologies, they hardly need any resource except for your mostly brain, and then whatever electricity, with very least amount of infrastructure, probably computers, laptops, or even the so-called uh, tabs, and then network and broadband. This is what you need, and the rest you can generate a lot of services and products. Like Apple has pioneered this. They started with this kind of strategy, where they have developed something called as a platform. So they brought three people together: one, they themselves, with the developers, and then the end users. So there was a constant interaction. Due to this constant interaction, they kept on producing so many platforms, all the applications, apps. Even the Android also did the same thing. All the apps which you find in your mobile, they're all product of the so-called concept of the platforms. So in the platform business, leader takes it all. There will be only one leader. Rest will be totally vanished. So that is the problem with this new gen technology companies. So, and then third important aspect when it comes to young growth companies is survival probability. What is the probability that this company will survive with the amount of, see, you need to see the threat from their competitors. The second is, see, in that kind of, the platform kind of a businesses, you will switch over only when the switchover costs are lower. Then the speed is three times of what the first mover has given. Then the amount of so one is speed, quality, quality of services which is delivered by the such kind of service provider. So if they are there, naturally the people will switch over. Otherwise, it will be very very difficult for a newcomer to enter into it. And you have to see how, what is the probability, who the competitors are, whether this growth company is going to survive or it's going to collapse. And then when it comes to growth companies, young growth is at a very infant stage. Then growth company is the next stage, where the industry will be set. There will be certain standardizations, and then the products and the quality keeps on improving. And this is a stage where most of the companies go bust. Once they go bust, there will be only few companies which are genuinely good, and they have a very good solid team. Then they have a very good business model, and they put a lot of money and emphasis into the so-called R&D. So such kind of companies will survive. And when during that phase, what you need to see is how much they could scale up the growth, and whether they could sustain the margins. For example, if you take the telecom sector, we just see now we have four players. Initially there were around 20-25 players initially. Then later the left out players are, now it is Jio, then your Airtel, Vodafone and Idea. These are the only three players which are left out, along with BSNL, which is almost in the deathbed. It's on the ventilator. So everybody, it's very doubtful whether they will continue or not. So now it may finally end up into a duopoly from a triopoly. So there is a chance. And then who is scaling up? Because during a particular stage, your market gets more or less moving towards the stage of saturation. And how much growth potential is there, you need to check. And what is the, whether they could sustain the margins. This is the another aspect. Then comes is the mature companies. It is a phase where the players become less, and then they will go for consolidation of businesses. In this phase you find a lot of mergers and acquisitions. Companies will try to purchase other companies, or they will bring up certain products which will throw the others out of market. So in that, what you need to see whether operating slack, how much operate that that the growth is possible in terms of numbers, that quantity. Then financially, financial slackness, and the probability of management change. If the management changes, naturally, if the then there is less scope for the company to be performing better. Then there is something called as a declining companies. In declining companies or any industry, as we have discussed, like say radio, TV, all those stuff, refrigerators. There, what you have to see is you have to apply the principle of going concern value. What is the value if you if a company is being sold? What will be the value it derives? Then what is the probability that it will be defaulting? And what were the consequences of such default? So if you happen to put money into such kind of companies, then you have to take these three into consideration. For example, I have invested into two companies. Called, one is Alok Industry, the other is Future Group. So it was over optimistic projection without taking into consideration all these things, and I end up into losses, around 3 to 4 lakh rupees only into these two companies. So you have to be very careful while choosing such kind of a companies. And the other one is, I have taken this Gitanjali Jewelers. one lakh is totally gone, vanished. So then financial services firm. There are, so this is one area very interesting. If you see broader terms, even Indian markets or any other markets, the most of the benchmark stocks will be from finances, be it banking sector or NBFCs or insurance or any other financing service providers. So what you need to see is what is the risk, equity risk, like risk of that company be getting failed, right? And then what is the quality of growth? In that quality of growth, you have to see return over equity, ROE. ROE should be more than 15 percentage. And then the regulatory capital buffers. Like, see, recent Paytm is again a regulatory issue due to which, they landed up into trouble, and then that CFO, CEO had to be sacked. So you have to be very careful about these risks. These are some of the factors. Then comes is your commodity and cycling companies, right? Those companies who are involved in cyclical industries like AC, then your commodities like steel, then metal industry, or agricultural commodities, or like the so-called fertilizers and other chemicals. So in that you have to see what kind of earnings, normalized earnings over a period of time, then excess returns during the stage where they are in the boom, and what is the long-term growth of these companies. And if you see the cycle of these commodities, you find it to be having a sinusoidal cycle where, as I said, it is subjected to so much of market fluctuations and business cycles, that there is always they perform well when there is a boom phase, and then they fail to do well and they incur a lot of losses when there is a dip in the so-called demand, especially during recession. And then finally, it is intangible asset companies like IT companies and all. You need to know what is the nature of those assets and efficiency of investment in intangible assets. These are the factors which will drive uh, across various companies which are at different stages of growth. This is for today, and then next we will start with the next slide, which will be how to find undervalued stocks and all that stuff. So, any questions? Now it is open to public. Hmm. बताओ boss. Pardon me. Returns. हाँ. नहीं, वो हम लोग उसका तो वी आर अबाउट टू कम टू दैट. Actually, 13 to 14 percentage which I have given is assuming that you have invested into stocks which are index stocks like Sensex या Nifty 50 में है, तो that is what is the return. Not for every stock. Okay, not. हाँ. Hmm. अच्छा, let me go back. You just tell me what is that stock. Thing. इसमें ये नहीं. ये नहीं. ये वाला, ये वाला, right? Hmm. Right. Hmm. So this is Sensex. This is a fact. क्योंकि there are so many research which is conducted, and they have found कि this is usually this is what is the return which a good mutual fund will give if you invest. Yeah. नहीं नहीं नहीं, that's too लास्ट 2 years का नहीं है, इट इज ओवरऑल मार्केट का कंडीशन हुई है. See, growth is continuing ना. Indian growth story is going to continue. It's not going to end, right? So growth जब continue होगा, naturally कौन कहाँ पे growth होगा? It is the companies, right? Corporations they derive or they create the wealth. So उसका growth है तो अपना भी growth हो गया ना. So in fact अब मैं बाद वाला स्लाइड्स में इन फ्यूचर टू कम आई विल शो यू ऑल दोस स्टडीज जहाँ पे वो सब आए थे ना, वो दिखाएंगे आपको. और यहाँ पे एक और चीज भी दिखाया था ना, आई थिंक वन मोर स्लाइड आई हैव पुट इन व्हिच गेव यू, आई विल जस्ट शो यू, आई थिंक और पीछे में होगा. नहीं नहीं, मैंने आज ऐड किया था कुछ स्लाइड्स को, उसमें था. उसमें क्या है कि वेरी इंटरेस्टिंग, वो आई थिंक ये देख रहे हो, इसमें ब्लू कलर वाला जो है दैट इज इंडियन इक्विटी 1990 से लेके 2020 तक. यहाँ पे इफ यू सी द फुटनोट, इंड इक्विटी इंड इज रिप्रेजेंटेड बाय सेंसेक्स फ्रॉम 1990 टू 2020. बाद में 2002 से वो बन गया है निफ्टी 50. ओके, निफ्टी 50 का ट्रैक किया था तो उसका जो है 68 टाइम्स जो है वो बढ़ गया था विद इन दैट 32 years. वेराज यूएस इक्विटीज इंडियन रुपी कन्वर्ट अगर करेंगे तो तब उसका जो है इट हैज ग्रोन बाय 55 टाइम्स. 55 टाइम्स. हेलो, यू आर हियरिंग राइट? सो सो ये है, आई थिंक दिस विल मेक इट वेरी क्लियर कि मैंने एक और ये भी अपना ग्रुप में डाले थे ना, वो तो अमेरिकन है, दैट इज बेस्ड ऑन अमेरिकन रिसर्च. वो तो आई थिंक 36 years कुछ है. इफ यू गो थ्रू दैट, आई डिडंट पुट दैट स्लाइड ओवर हियर, बट इफ अपना ग्रुप में दिख जाएगा, वेल्थ मैनेजमेंट वाला ग्रुप में वो रिसेंटली मैंने डाला था. उसमें 1 मिनट में बता देता हूँ. उसमें क्या है, see, if had you invested $100 in S&P, Standard and Poor का 500 companies है, they are in Dow Jones में है. If you invested that $100 in 1970, it would have become by today it would have become 22,419. Means it grew by 224 times. 224 टाइम्स वो ग्रू बढ़ गया था. वही चीज अगर पैसा में रखे हैं, पैसा इन द सेंस इफ यू पुट इट टू बैंक, दैट $100 वुड हैव बिकम $954. 9.5 टाइम्स बढ़ गया था. वही चीज रियल एस्टेट में जिसने पैसा लगाया है वो बढ़ गया है 15.42 टाइम्स. और यूएस 10-year ट्रेजरी बॉन्ड्स में जिसने लगाया है वो बढ़ गया था 22.86 टाइम्स. और गोल्ड में जिसने पैसा लगाया है that has increased by 54.45 times. एंड कॉर्पोरेट बॉन्ड्स जो अच्छा ग्रेडेड कॉर्पोरेट बॉन्ड्स में जो पैसा लगाया है they have grown by 77.75 times. So this is what is the growth. इक्विटी में 224.14 टाइम्स. दीज आर फैक्ट्स. ओके, ये चेंज नहीं होता है बस. आप जितना भी देख लीजिए, वी ऑलवेज हैव दैट काइंड ऑफ अ डाउट इन आवर माइंड, बट वी नीड टू अंडरस्टैंड वेल्थ इज ओनली क्रिएटेड बाय द कंपनीज. हमारा पास कोई वेल्थ नहीं रहता है, हमारा पास डेट रहता है. डेट कर्जा, ठीक है, पैसा उनके पास जाता है. So you have to be, wise, smart to get into it. नहीं, next Sunday I am taking leave क्योंकि I am moving out. Next Sunday will be a gap. Next वाला में मैं आएंगे. I will discuss something on Warren Buffett का Warren Buffett way of wealth management. वो बहुत ही अच्छा टॉपिक है. Because if you want to know become rich or be successful, you need to have a role model. बिना रोल मॉडल का कोई भी डिस्कशन अधूरा रह जाता है. ठीक है. Warren Buffett is the only person since 1970s. He was the only person consistently in top 10 richest in the world. आज भी है. So ये without discussion about him, his thought, his philosophy, हमारा कोई काम का नहीं है. जितना भी डिस्कस करो उसको कोई फायदा नहीं. That need a little preparation, क्योंकि आज तक मैंने उसके बारे में सुना है, अभी कोट भी किया है, बट अगेन उनका प्रिंसिपल्स मुझे पता है, बट अगेन आई नीड टू डू ए डिटेल स्टडी ऑन दैट. ठीक है. एंड दैट विल बी वेरी इंटरेस्टिंग. दैट हाँ हाँ. Anybody would like to ask anything? Any newcomers? Yeah. Right. Right. सी वो उल्टा होता है. सी बुल ट्रैप में क्या होता है, आपको लग रहा है कि इट इज इन अ बुल फेस. ओके. बट दोज पीपल, स्मार्ट पीपल हु हैव पुट मनी इनटू इट, they increase it, they will come out of it. जो बच जाते हैं, they are into a trap whereby it keeps on continuously falling. Right. वो fall हो जाता है to such an extent that your investment will erode. Even in my case it happened, it eroded by 90, 95, 98 percentage. So this is a bull trap. When it comes to bear trap, वो जो opposite of it. ठीक है. वो गिरता है, लगेगा कि वो गिर रहा है, but again it will rise up. So these are the two phases which are used. Is that clear or should I show you that? ये अभी दिख रहा है ना? Yeah. Yes. Yes. Bull trap. Yes. Yes. So ये usually हमारा जैसे लोगों से होता है. Because we don't know the insider stories ना, हमारा पास पूरा information नहीं रहता है. So ये generally operator driven जितना भी stocks है ना, उसमें ये सब होता है. So what we need to do is we need to smartly understand कि we have to avoid certain stocks. So what I usually do is I don't look at which stock is growing. That was never my. अभी का strategy change हो गया. Previously I used to look at the other side, the so-called gainers. Now I see the market losers, and in that I will see only those companies which are good. जो गिर गया पैसा डालो. That's how you gain more. Yeah. Great. Right. Yes. नहीं, see, yeah, right. Right. No, actually, yeah, yeah. I can tell you the reason. Okay, I was in DPAM, Department of Investment and Public Asset Management for some time. Yeah. What? Yes. Mm. Right. 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 No, in fact, मेरा अभी का I see now right now my portfolio is mostly with PSU stocks. Okay, that the reason being, I'll tell you, prior to 2016, especially 2011, during UPA era, they have given more autonomy, and then there was almost very less interference by the government. So the companies and the management were more or less independent. They took their own decisions, and it risen till 2016 when Department of Disinvestment was formally changed to DPAM with a changed mandate. Previous mandate was not to sell any company, only to offload some. It is called as a minor stake sale. Now, in 2016, they came up with a big bang, policy stating that we will sell off. Government is not into the business of doing business, so we will only we will sell off the business and come out of these segment, PSUs. So that was the philosophy with which the present government came. So in 2016, initially the targets were given, but it could not be taken off. But the majorly it was in 2017-18 when the disinvestment proceeds reached around 1 lakh crores. Okay, and then they started whatever the sale was only with the PSUs, but not private. No company could be sold except one, which is Air India. Air India is a company in which Tata has taken over with a lot of news and all that stuff, with controversies and all that. And there was one more which was also sold, which is called as Central Electronics. But however, because the company which has purchased is basically into financing and all that stuff, people that whatever disinvestment was cancelled. Okay, these are the only two private sector sell off. And then during that time, when I was between 2018 to 2020, the peak of disinvestment. So we were meeting the investors. Usually, investors are all institutional investors, be it FII or BIS. So FII naturally, obviously, you have to go to Bombay only. Bombay, we met uh, you can say the guru. PSU guru is one gentleman by name Prashant Jain. Right now, initially he was with the HDFC. Right now, he has his own company. So that guy, उनका very very valid था उनका question यही है. When we went to offer some stake sale, I was at the time looking after two companies. एक हडको था, एक NBCC था, NLC पे गया था. NLC I was to some for some time I was involved with NLC also, Neyveli Lignite. तो उस समय पे गया तो what he was saying is he told very clearly, boss, we don't mind purchasing whatever the stake you sell, but you tell us very clearly how many times you are going to disinvest. Don't say that I'll only do this and then again you come up and then you sell it again. And this will lead to because they have all the investors whoever put money into it, they all ended up into around their capital got eroded by 50 or 56 percentage. That is in 2018 July 2018 I started. So then came there was a phase when their decision of SEBI, went to the mutual funds. What they said is you just have only one option. Another option is like you tell us very clearly. Uh, you 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 sell off say 10%, 20%, but in only single go. Don't sell it multiple times. Multiple times we always have a thought कि हाँ जैसा है वो आप भेजेंगे वो तो स्टॉक गिरेगा जितने बार भेजेगा उतना गिरेगा लास्ट टाइम विल गो एंड परचेस so this is what the concept is. So and then mutual fund का भी क्या था वो जो mutual fund agencies को सेबी ने गाइडलाइन दिया है कि you cannot sell off these equities, especially you cannot purchase mid cap and small cap when you are dealing with large cap. Where with that, this entire PSUs which were into mid cap and small cap, even otherwise because of the disinvestment policy, they all collapsed. वो collapse इतना तक गया था जैसे कि BHEL, it went up to almost 400. 400 से it went down to I think 20 or 30 उस रेंज तक चला गया था तो अभी hundreds में है so there was a erosion. Now recently I am hearing, I don't know because we can't predict what is going to happen in future. Now I heard it from you know the top level, like I would not like to name them, but they are saying that disinvestment is a era of past. I don't know whether this is true or maybe the government may come up one fine day and say that yeah we are going to disinvest XYZ company. And the moment they come up with that statement, it will again fall. So this is why it is growing is still अभी जो बेल को ही ले लो BHEL. BHEL right now 130 140 range. Okay, still it hasn't touched that 400 peak. So I still feel some companies still have further steam left out. But again, one thing I can definitely tell you, CPSEs will give you very good amount of what do you call dividend अच्छा मिलता है. Dividend. Then the other why I'm still sticking on to it is they also give you bonus and split. ये भी देते हैं. So I'm sticking to it. I think that yes, वो तो करेगा ही. And then there are the policy of this government of India is also very clear कि certain strategic sectors के अलावा बाकी में वो disinvest करेगा. Those strategic sector, oil, power, all that stuff, ना कुछ sectors. Okay. So in that they will not do any disinvestment. So those are the safe bets. So PSU banks, yeah. नहीं एक समय पे था या एक समय पे था at one stage that was the situation later they understood it is very difficult and इतना अभी आसान नहीं है वो सेल करना because we have seen that process ना it is very painful not many people are interested in it not many people so क्योंकि बड़ा कंपनीज को खरीदना है तो बड़ा लोग ही आना है there are very limited players who can purchase it so उतना ये भी होना चाहिए ना कि they have to have that much of wealth or income क्योंकि whenever there is a sale you have to pay in cash there is nothing called as a kind in disinvestment and government will not take equity and then uh, go off. You have to pay cash. So, how many companies have cash, say 10, 20, 30, or 40,000 or 1 lakh crores? See, say a company like BPCL, yeah, IOCL, you have to pay in lakhs of crores. So, which company is capable? ये भी एक बात है. नहीं वो तो वो yes. See, I'll tell you, most of these companies, good companies, they already reached almost below 60 levels. Some companies like Gale is just 51, just striking, it's just okay. So they are just already here. Even all oil giants, they are all above. You can say below 50, below 60 percentage making. Right. No, see, regarding Coal India, I can say that is cash-rich company in the entire PSU segment. उसका cash इतना ज़्यादा surplus है, and then government once they see a lot of cash with a particular company, they will churn it out in the form of dividend. तो आपको अच्छा खासा dividend मिल जाए. And it is a monopoly company है. It is going to there for another 20-30 years तो आराम से रहेगा ही. So it will be good company. See what I understood and seen is all the PSU companies, including banks, they all are very good. They pay you good dividends. And then bank जो इतना erode हो गया था ना value. So I felt it to be very one of एक merchant banker का बताया है मुझे IDBI का. I could not recollect his name. That fellow told very clearly, you know, he's a Punjabi guy from Delhi. उसने बोला साहब ये जो these ये जितना भी PSU stocks है इतना गिर गया आप जो है खरीद के रख लीजिए. You purchase it, it will grow. It will not vanish. At that time I was very shaky about that NPA thing and all. I was not very comfortable. But again, what he said, later on, what I did is I started accumulating PSU stocks, PSU banks. Now they are, मुझे तो minimum 3x, 3x, 2x, 3x का profit मिला है उसके साथ. So yes, yes. Punjab National Bank, yes, right, exactly. Yeah, they are very undervalued. Yes, of course. So that's why what? Yeah, yeah. Mm. Very interesting question. I'll just tell you. See, if you see Indian economy as a whole, we are a bank dominated economy. It's not unlike USA, which is market dominated economy. Here, the funding is to be done by the banks predominantly, and no government, no whatsoever, howsoever foolish they are, okay, howsoever foolish they are, they cannot ensure that the banking sector is totally doomed. So that is the reason why I have decided, I have faith at least. No foolish, I don't think any leader is so foolish that they will put everything to stake. So it will remain, and I put lot of money into banking sector. So my portfolio is predominantly banks. So it will grow. It will grow. It will come. These are all temporary setbacks, and anyone who fiddle with banks, they are fiddling with the entire economy. And if the bank collapse, entire economy will collapse. And I don't think that is going to happen in any time to come in future. Yes, yes. They see. I'll tell you exactly. And the other thing also, bank, as if you see from the beginning, from our independence era, they have initially started, till 1916 until nationalization. All the bank collapses, bank, everything is a daily routine. Every year, some 10, 20 banks used to collapse, right? And also, you might have seen some 20, 30 years ago, prior to the control of RBI and especially on the NBFCs and cooperative banks, this was the order, right? Now, you hardly find such kind of events for the reason because RBI has become very, very tough and they are regulating very well. So, I don't think that in any time to come, this banking sector is going to collapse. And at least we should have faith in our own, RBI and system. Yeah. Mm, mm, mm. It all see. I still feel they are doing very well. If you see IREDA, all those companies, they are generating good, very decent returns, very decent returns for their investments. You just see the kind of returns they are generating year by year. And again, whenever they generate surpluses, naturally government will plow back in terms of dividends. So that is where you will keep on getting it. It's a phase, it's a cycle. There will be good times, bad times. On an average, I still feel they give you decent returns. Yeah, yeah, great, great. No, I'll tell you. I'll tell you. Anyway, we are now we are entering into that next phase. See, if you tend to stick for very long, okay, your growth will be much more. than you selling it off and then re-entry. Reason being, I'll tell you, for example, say you have taken a stock X, okay, it has grown according to you, say, even your portfolio right now has risen to 2x, right? Yeah, 3x. It's now 3x, right? 3x. If at all, the proven fact is like market, whenever it crashes, it will not crash beyond 50%. It will not. If it crashes, your maximum losses you will be incurring is around 50%. 50% of 3x is 1.5x. Still you have 0.5x extra. Okay. Now, when it grows, if the more it falls, the more it rises. So usually 100 to 200, 300 percentage rise will be there. So assuming that 200 percentage on an average, let us say 200 percentage it has risen, right? 2 into 2 into 1.5 is again 300. 3x means 4x. It becomes 4x. Your your value of your portfolio will become 4x. 4x after that, even if it falls, if you see the iterations, finally you'll end up say after 10, 20 years, 10 years maybe 8x or 9x. And then after 20 years it will go to 20, 30x. So you have faith in it, right? It's a growth curve. It is growth curve. We don't know. There will be ups and downs. They are all temporary. Okay. Re rebalancing rebalancing का ही हम लोग we are going to have a session on coffee can portfolio. Okay. Coffee can portfolio is a very successful success story. You should not touch it. You know, ये Robert Kirby करके is a wealth manager in USA. He found this. He coined this word. You know, he observed a very strange thing in 1980s when he is one of the most successful wealth manager and a fund manager, and he found strangely one of his customer, you know, or the client. He did not. He forgot to see what is, you know, check it, and he did not do that so-called active trading. And then finally, after 10 years, when he saw his portfolio has grown multiplied by 7 or 8x, and then he went into deeper. He studied. He put forth a, you know, research paper. I have shared it with somebody. I'll put it in our group also again. So finally, it is proven based on that. If you see Saurav Mukherjee, Ambit Capital, all these people, you know, they all came up with this concept. They come up with, you know, they do the portfolio management, and I'll put that in the subsequent slides also. I think you have to continue further. Then only you'll see the entire, you know, the continuation of whatever we are discussing. So consistently, it is proven that all these coffee can portfolio they increased by minimum 19 percentage, and it goes up to sometimes in good years maybe 30 percentage. So it is proven. Okay, so you continue with it, don't sell it. Okay, that's what I was yeah, yeah, right, right. Mm, mm. No, again, again, this is one stage, right? They may have continuous cycles. This is one. And as I said, the risk is very high in badly performing companies than good companies. If you have put money into good companies, it will come up. This cycle will continue. If it is a bad company, it is bust. So that is why the choice lies with how you identify good stocks. Okay. Chalo, we will continue. I think today it's already 23 minutes extra, and my daughter is waiting to eat. She didn't had food, I guess. Okay. Okay. Right. Bye.